In a modern economy, you don't always need to buy an asset to generate value, you just need the right to use it. But conventional leasing structures are frequently loaded with hidden interest and unfair risk transfers. Today, we break down Ijara, the definitive asset-backed framework that separates legal ownership from user utility. The foundational secret of Ijara lies in a concept called Usufruct. Under this framework, a financial institution does not lend you money to buy equipment. Instead, the institution buys the asset, retains full legal ownership, and sells you only the right to use that asset for a specified time frame in exchange for a fair rental payment. To remain valid, an Ijara contract must meet 3 criteria. First, the asset must be used for a constructive, ethical purpose. Second, the asset cannot be something consumed by its use, like fuel or raw commodities. It must be an enduring asset like real estate, vehicles, or hardware machinery. Finally, the lease duration and rental pricing must be crystal clear from day one. This is where the ethical line is strictly enforced. In conventional triple net leases, the owner unfairly forces the tenant to pay for structural risks. Ijara rejects this. All core ownership responsibilities, such as major structural damage, property tax, and fundamental insurance, must be borne entirely by the owner. The user is only responsible for the daily operational upkeep required to run the machine. Because you are only paying for the use of the asset, a radical rule applies if that asset breaks down through no fault of your own. If a leased factory machine or office server becomes completely unusable, the rental payments are legally suspended immediately. The bank cannot collect rent on a utility it fails to provide. But what if you want to keep the asset permanently at the end of the lease? This introduces a highly popular structure known as Ijara Wa Iqtina, or hire purchase. This matches the function of a conventional lease-to-own model, but executes it without bundling conflicting contracts together. To prevent structural ambiguity, or Ghaaraaar, the institution cannot merge the lease and the sale into a single, confusing document. They must execute 2 distinct steps. Contract 1 is a standard, clean lease. Accompanying it is a separate, legally binding promise that once the lease timeline concludes, the owner will either gift the asset or sell it to the user for a minimal residual fee. Just like Murabaha, default management under Ijara is heavily regulated to block riba. If a lessee defaults or falls behind on rental installments, the owner can issue a penalty fee to discourage negligence. However, the bank cannot add this fee to its revenue ledger. Every cent collected from a late penalty must be entirely purged into a verified charity account. The Ijara framework offers a brilliant model for modern asset management. It proves that businesses can efficiently access high-value infrastructure and scale operations smoothly, while keeping risk and rewards perfectly balanced and transparent. Now that we have completely mapped out the fundamental pillars of ethical trade finance, equity partnerships, and asset leasing, we are ready to scale our knowledge to the institutional level. In our next lesson, we break down Usufruct, the asset-backed alternative to conventional corporate bonds that powers mega infrastructure projects worldwide. Hit subscribe, and let's keep building wealth with a conscience.